Hello, learners. Welcome back to our segment. I am instructor CPA Ringo Frederick. This class is a continuation of our revision. Remember, in our previous class, basically we had introduced the concept of our revision, and we were looking at consolidation, or rather group accounts. And basically, we did several concepts in our last class on introducing consolidation, up to the point whereby we mentioned that some of the key items that you must always tend to have in mind. And we said that our segment today, we are going to look at a question which was tested in our past paper, and that is August 2023, question number 3. So I'm mentioning that, my good students, anytime you're dealing with consolidation, at whichever level, you'll find that this will always be the main important concept that you must always tend to have at the back of your mind. Number one, my good students, it is very important for you, first of all, to identify the aspect of the financial period. Financial period will literally assist you to be able to understand the concept of post-acquisition and pre-acquisition. Number two item that you must always be able to identify, basically, it is the group structure. What is the importance of group structure? The importance of group structure basically is to enable you to know if you're having a subsidiary, if you're having an associate, or if you're having a joint venture. That is very important for you to have in mind. Number three, my good students, we say that at this point, these are now the computation or the only workings that you'll always be required to have. The rest, you can always do them with your calculator. So at this point, you should be able to compute your retained earnings of the parent, retained earnings of the parent company to be reported, retained earnings of the parent company to be reported in our statement of financial position. Okay. The other key working that you must be able to compute, basically, it is the NCI to be reported in our statement of financial position. And finally, number 5 here, it is the aspect of investment in associate or joint venture to be reported. Investment in associate, or in this case, in associate or joint venture to be reported in our SAP. So these are literally very important concepts that you must always tend to have in the event that you are talking of what? The aspect of consolidation. And remember, in our previous class, Mwalimu had guided us in relation to how we can always tend to prepare this. So this will take us directly to the question that I want us to handle. Basically, this question was attested in August 2023, question number 3. And by the way, before we start that question, I wish to share with you guys this. I'm having a friend, his name is Douglas Muhati. Douglas Muhati has been having this initiative for the last now 3 years of supporting CPA students. Supporting in terms of basically donating these books to the national libraries around. So the first drive, in this case, the initiative is being termed as book drive. The first book drive was in basically Kakamega National Library. The second book drive was done last year. That was in 2 libraries, basically talk of Nyeri and Kisii National Libraries. Our third initiative, is the third initiative which it is going to be basically conducted. And the libraries, beneficiary libraries in this third drive will be Kapsabet Libraries and Mombasa, Kenya National Libraries. This initiative is basically to make sure that students who have maybe aspect of financial difficulties, or students who wish just to make sure that their knowledge of CPA is enhanced, they can access these books at these libraries purely for free. So I'm appealing to you, my students, if you're having any book outside there for CPA or CASNEB course that you know you're not using, I wish you guys to donate it, at least so that we can take to these libraries. You can always reach out for basically aspect of in-kind donation. You can always reach out, my good friend CPA Douglas, on 0712 318 707. This is a number of CPA Douglas. You can always reach him out whenever you feel like you want to donate basically these books in kind. And also, for those who wish to donate the same books in kind, you can also reach us out. We can take it to basically CPA Douglas for that drive. And for those who wish to donate basically now in terms of cash, kindly, I'm sharing these details with us. Let me share these details so that you can see it clearly. You can always support, and I know you guys are going to support this initiative, right? Just to make sure that at least guys are getting these updated CPA books for their studies. So I've literally shared the details there. The CPA books drive, 3rd edition 2023, Mombasa and Kapsabet libraries. So I've shared the details. You can clearly see just below here. Yeah, I've shared all these details. That is a till number that you can use to donate your cash. Let us, for those, of course, I know majority of you will be willing, kindly let us make sure that at least we are spreading this good news, right? And it's a very noble initiative. Kindly, Mwalimu is requesting you to support this initiative. Thank you so much, guys. Let us go back to what you are doing, and that is, of course, August 2023 question. I'm going to leave that one there for a while so that for those who are getting the details can get the details, right? So jumping to what we are doing, the question that we are handling, I'm literally sharing this question with us here so that you can have it. This is August 2023. So let's go through this question. All right, let's go through this question. And in this question, basically, these are what you're told. If you can check the question I've literally shared with us there. So I'm having this company known as Pika Limited. So we're told that Pika Limited, right, in this case, having noted whatever that we need to have in mind. So we are told that Pika Limited, a public limited entity, intends to expand its operations by acquiring investments in other entities. Very key to note. In this case, you are told that on 1st November 2022, Pika Limited acquired a 75% equity interest in Shiba Limited under the following terms. These were the terms. Number one, an immediate cash payment at a fair value of 13 per share on 1st November 2022. Dash two, an issue of 3 ordinary shares of 10 shillings per value in Pika Limited for every 5 shares acquired in Shiba Limited. So I'm talking about number one, cash consideration, and I'm also having what? The share exchange consideration. Then you are told the share issue has not yet been recorded by Pika Limited. That is to say, whichever shares that we have acquired, it has not yet been recorded in the books of Shika. So the ordinary shares displayed there in Pika, it is exclusive of the shares that we acquired. That is very important to note. Then talk about the following draft statements of financial position, as that before that we're told on the same date, Pika Limited also acquired 30% equity shareholding in Amua Limited, paying 24 million in cash. There was also an acquisition of another investee company. In this case, I'm having what? 30%. Of course, when we'll be analyzing that, it will be clear to know that in terms of our structure. So we'll check it out. Then I'm given here like the following draft statements of financial position as of 30th April 2023 relate to Pika Limited and Shiba Limited, right? So what you are given here basically is our non-current assets, current assets, equity, non-current liabilities, as well as the current liabilities. Okay. Talk about additional info. Additional information. These are basically what we were told in additional info. Believing that is very clear. So additional information, these are what you're told. That number one, as that at the date of acquisition, the fair value of Shiba Limited net assets approximated their carrying values, with the exception of plant whose fair value exceeded its carrying amount by 10 million. So on the acquisition, I'm having a value which basically exceeded our other plans. So therefore, in that case, there was an extra value which will also affect us, fair value adjustment on the date of acquisition. And this plant had a remaining useful life of 10 years. At the date of Shiba's limited acquisition, the plant is being depreciated on a straight line basis. The plant is still carried at its carrying value in Shiba Limited's financial statements. So basically, this is in the books of the subsidiary, and therefore we'll have to compute the depreciation on that. So it is as if while charging our depreciation, we had a value of depreciation that was never considered. So whichever depreciation that we charged in preparing our books was understated. So I'll have to cater for understatement or that is of course depreciation undercharge. No fair value adjustments were necessary on the acquisition of investments in Amua Limited. Note 2, we are told on 28th April 2023, Shiba Limited sent goods at an invoice price of 7 million to Pika Limited, which Pika Limited neither received nor recorded until 5th May, right? So by that fact, it would give us what? The concept of goods, or rather the concept of, that was of course the concept of goods in transit, which will have to cater for that, amounting to 7 million. Shiba Limited had marked up those goods by 25% on cost, right? So I'm also having a component of the goods that were marked on cost. So number one, key element, I'm having the goods in transit. At the same time, I'm having the intercompany sales, right? Which will have to consider that. Remember the double entries that Molimo shared with us the other time. Then I'm having basically the other item here that we told, the agreed trade payables recorded in the books of Pika Limited before the above transaction was 6 million. Another intercompany sales which will have to deal with it. Then we are told that note 3, Pika Limited's policy is to measure the non-controlling interest at fair value at the date of acquisition. For this purpose, the directors of Pika Limited is considered Shiba Limited's share price of 12 per share to be appropriate. So whatever the examiner is giving us there is giving us a lead in determining the NCI fair value. Note 4, we are told, impairment tests performed on 30th April 2023 revealed that goodwill on acquisition of Shiba Limited had not been impaired, but due to declining sales of Amua Limited, the value of investment in Amua Limited had been impaired to the extent of 2 million. So literally there, we are supposed to determine our impairment loss, but in this case, in relation to what? The business in Amua Limited. Amua, based on what we saw there above, we had what? It being an associate. Then note 5, you're told, Amua Limited reported a profit after tax of 4 million for the year ended 30th April 2023. So that was the profit reported in Amua. Assume all profits and losses of the three companies accrued evenly throughout the year. Number one, we are required to calculate the value of goodwill arising on acquisition of Shiba Limited. Part B, determine the value of investment in Amua Limited. And part C, I'm literally required to determine the statement of financial position. Look at the marks that a good examiner is giving us. A good examiner is giving us 20 full marks for us to handle that question. That will be very basically easy to work. So therefore, let us have this question with us. Submission. This one I'm going to have it there for those who wish to donate. I'm having it there. And my question, let me just squeeze it to this point here. Right? So, number one, we are going to follow our guide, whatever that Molimo has given us, right? let us follow this guide whereby we've mentioned that number one, we should be required to identify the financial period. Then we identify our group structure, retain earnings of the parent. These are literally the only workings that you're going to have. And you're going to see how easy that will be. Okay? So allow me to raise this point. Number one, let us determine our financial period for the purpose of identifying the pre-acquisition and post-acquisition periods, right? So, believing that you guys, you can get this question, literally you can download this question. This is April, or rather August 2023. August 2023, question number 3 is a question that we are handling right now. So, let us follow the procedures. Number one, let us identify the financial period. The financial period, in this case, you're given that it was ending on 30th April 2023. So we can agree and say that my financial period, it was as if it was starting. This is our financial period. If it is ending on 30th April, it is ending on 30th April 2023. Can we agree that this financial period started on 1st May 2022, right? That is when our financial period started, based on what you are given. And based on the other component that you're given there with a good examiner, Pika Limited, a public limited entity, intends to expand its operation by acquiring investments in other entities. On 1st November 2022, so there was a period of acquisition here. We acquired this company on 1st November 2022. Okay, that is the period that we are acquiring this investee company. We acquired basically 75%. So before that, I can literally come and determine our periods. The first period from 1st May to 31st October, this will give us what? This is a post-acquisition period. Post-acquisition, or rather pre-acquisition, because we are talking of before acquisition. For this period, I'm having what? This is a pre-acquisition period. So you're talking about pre-acquisition period. Okay. The other period I'm having, post-acquisition period. Very important to note. So that will guide us. Number 2, let us have our group structure. Because I'm told I'm having Pika Limited here, so very confidently, I'm going to have Pika Limited here. Pika Limited. So Pika, these are what you're acquiring. Pika, these are what you're acquiring. Remember, this is just to guide us. For the purpose of exams, you can always have this in mind and work them out very quickly. Okay? So, Pika Limited, number 1, we acquired Shiba. And we also acquired Amua, as per what the examiner has given us here. Percentage of acquisition in Shiba, we were given 75% of the equity. Whereas in Pika, I'm given 30%. So that is to say, that will make Shiba a subsidiary and Pika, or rather Amua, an associate. Why? Because more than or 50 plus 1%, that investee company will be a subsidiary. Whereas between 20 to 49%, this investee company will be an associate, right? So I'm mentioning this in our subsidiary. Therefore, in this subsidiary, I'll be having these two components, right? I'll be having, number 1, talk about aspect to do with the parent. Parent, I am acquiring 75%. So the non-controlling interest, I should be talking of 25% being our structure, right? Very important to make sure that we have this for the purpose of us being guided to the next component, right? Then the other element that we said you must always be able to have is literally our purchase consideration. So I'm going to have my purchase consideration at this point. In our case, my good students, we can literally agree that in this case, we acquired this investee company with two modes. The first mode was the cash payment. The second mode was the share exchange, based on what the examiner has given us there, right? So let us work out what was our cash consideration. Cash consideration here. For cash consideration, we are told that, number one, in that the second sentence, you're told, on 1st November, Pika Limited secured a 75% equity interest in Shiba under the following terms. An immediate cash payment at a fair value of 13 per share, right, on 1st November. So we need to determine, if I was paying 13 per share, how many number of shares did we have in Shiba Limited? Because that is a subsidiary that we are acquiring. How do you get the number of shares? I want you guys to check on your equity. Let me raise it at that point. Check on our equity. Check on our equity. The equity component, in this case, you're told for Shiba, our concentration basically is on the subsidiary, right? Shiba, the total value of our equity, we had 80,000. This is the total value of our equity. The par value of our equity, in this case, we are given 10. So this will give us the number of shares that we had in Shiba Limited. And what percentage are we acquiring in this context, my good students? We are acquiring only 75%. And we are acquiring at how much? We are acquiring this, you are told, at 13 shillings per share. So therefore, in this case, I'm having basically 13 shillings per share. This will give us how much? We do it together. I'm having 8,000, 80 divided by 10 times 0.75, 6,000 times 13. This should give us a value of how much? I'm getting 78,000. Then the second segment, my good students, if you can continue the next sentence here, we are told, number 2, we are going to issue 3 ordinary shares of 10 shillings per value in Pika Limited for every 5 shares acquired in Shiba Limited. So this is what is happening. For every 3 shares of Pika, I'll be getting 5 shares of Shiba Limited. So this is to say, share exchange as our next component of consideration, I should be having, for every 3, I'm getting 5 shares. And in this case, how many shares did we have in Shiba? We've seen we had 8,000 shares, right? But I'm not acquiring all. In this case, of course, we are not acquiring all. So therefore, in this case, we should be having the value that I'm going to be given there. We are acquiring that at how much? At still the same value, which is what? Which is 13, right? Which is 13. So I'm going to have the component that we are acquiring percentage to give us the number of shares that we acquired times the value, which is 13. So this should give us, my good students, how much? 3/5 times 8,000 times 0.75 to give us 3,600 shares. 3,600 shares is what we were exchanging. So kindly note that times 13 to give us 46,800. So that is what I'll be having here. So that as at the end of the day, we can agree and say that the total value, my good students, the total value of the purchase consideration, I should be talking of 46,800 plus 78,000. This will give us 124,800. 124,800. That is what we should be having as our purchase consideration in that note. So we are done with that first bit, right? Then The other bit here, my good students, that we should always tend to have, of course, will be what? The other component to consider, let us check out on our basically NCI, right? Because that is another key item that we should be having. NCI, even if I will not told, you must compute our NCI. So NCI fair value, NCI fair value. How are we going to work out our NCI fair value? Let me show you guys. I want you to go to this note number. This was basically, if you can check it out clearly, this is a note number. Let me share this so that we can be on the same page. I want you guys to check note number 3. Picker Limited policy is to measure the non-controlling interest at fair value at the date of acquisition. For these purposes, the directors of Picker Limited consider Shiba Limited share price at 12 per share, at 12 per share, at 12 per share. So what would be our value for NCI? What would be our value for NCI? So let me squeeze this one here. We want to determine the value for NCI. So the value for NCI, therefore, this will be simple, because NCI at fair value, I'll be having, first of all, determine the number of shares that you're having, because you are paying this basically at the value that you're given. So the number of shares here, we are having the 80,000 divided by 10 to give us the number of shares, right? After we have determined the number of shares, in this case, they were going at how much? In this case, it was measured that these shares basically were going at 12 shillings, based on what a good examiner has given us. A good examiner has given us what? 12, right? So this should give us whatever that I'm having here as 12. Then the next question, what is the percentage of NCI? The percentage of NCI, you can clearly see, we had it here, we had already computed it to be 25%. So basically I'll be having my 25% there, which in this case will give us what? 8,000 by 12 times 0.25, this should give me 24,000. So therefore we can agree and see that the fair value of NCI, I should be having 24,000. As simple as that, as simple as that. So we mark that one somewhere. Now, the next segment we mentioned that another working that we should be having is the component of goodwill, right? Goodwill. We know very well that for us to determine our goodwill, my good students, we know very well, that one we know very well, that for us to determine our goodwill, we must always tend to talk of my purchase consideration here to about our purchase consideration, or basically cost of investment, with less our net assets on acquisition, net assets on acquisition. At this point, it is important, very vital for us to remember what we did in our last class in relation to determination of goodwill, because we already have our purchase consideration. Therefore, it will be upon us to compute our net assets on acquisition. That one will be very, very simple, my good students. So what will be the next task here? In this case, to determine my goodwill, already I'm having these two items. We have our purchase consideration. We have our purchase consideration. So basically I'll be having my purchase consideration here, purchase consideration. Have we determined that purchase consideration? We have determined our purchase consideration, right? We have determined our purchase consideration. And the purchase consideration, this is the value that we have determined, 124,800. So I'm having basically 124,800. Remember we said, in the event that the examiner has not instructed you to use partial goodwill, we're going to consider the full goodwill method. So therefore, I'll also have to cater for the fair value of NCI here, my fair value of NCI. Have we determined the fair value of NCI? Yes, we have determined the fair value of NCI here to be 24,000. After that case, we need to determine our net assets. Recall what we mentioned about our net assets. This one will be very simple because what will you need to do, my good students here, right? You'll only be required to consider the ordinary shares, talk about share premium, if you're having any, talk about pre-acquisition profits, right? We'll also be required to consider our fair value adjustment here. Talk about our fair value adjustment. Right? So once I have this, our forecast of all these items basically are in the books of the subsidiary, right? They are in the books of the subsidiary. That is very important to note. So what is the ordinary shares here? The ordinary shares in our case, as per in the books of the subsidiary, let us copy paste that. Let me share this. You can just copy paste it just at once here, and we consider that very, very quickly. So I'm copy pasting this bit here. Let me have the question there. Then I can squeeze it somewhere here to give us our allowance of confirming and checking it out. So basically that is what I'm having. We start by identifying, of course, our aspect to do with what? Our aspect to do with our ordinary shares. What is the ordinary share value there? Ordinary share, I can see I'm given 80. So I'm going to have my 80,000. As simple as that. Share premium, did you have any share premium? Our forecast, my good students, it is in the books of the subsidiary. We didn't have any share premium. What about pre-acquisition profit? Remember, we started by looking at that. Remember this concept here. And that's why it was very important for us to have that. So let me squeeze this one down here. You see, this one here. That's why we started with this, for the sake of that. So I'm having the pre-acquisition and post-acquisition. So my focus is on pre-acquisition. So on our pre-acquisition, my good students, we are looking at the period before acquisition. During this year, the period was from 1st May to 31st October. How many months are we talking about? We're talking about May, June, July, August, September, October. So you're talking about 6 months, right? So this case, we can agree and say that for us to determine this pre-acquisition period, I'm having, number one, the profit for this year, I'm having 6 months, which was post, or rather, which was post. And I'm having another 6 months, which was pre-acquisition. So identify the profit that we had for this current year. Number one, the profit that we had for this current year, what will we be having here? Check what I was given. The profit that we had, look at our retained profit. The good thing with this question is that it literally simplified for us. We told that the retained profit as at the beginning of the period, May, for Shiba, I'm having 12,800. So this one will be literally simple because I'll be having here 12,800 when we are starting. We are going to add the profit for the period. In this case, we had, for the year ended 30th April, the total profit that Shiba generated, we had 10,800. Look at that case, we had 10,800. But that 10,800 here, it was for the whole year. So I'm going to take my 10,800, this was for the whole year. We acquired this one in between the year. So times 6 over 12. Let me remove this question so that you can see this clearly. We are saying that we want to determine our net asset, or rather pre-acquisition. So even before we started this year, already Shiba had 12,800 retained earnings. Then we acquired this subsidiary in between the period. So the period before acquisition for that year was 6 months. And the profit that this company had made for the entire period was 10,800. That's why we are determining for this pre-acquisition. That will give us 12,800 plus 10,800 times 6 over 12. This should give us 18,200 as our pre-acquisition profit. 18,200 as our pre-acquisition profit. The first stage, right? As simple as that. Fair value adjustment. Check if you had any fair value adjustment. And clearly you can see we had a fair value adjustment. That was as per note number, check note number 1. The fair value adjustment you are given what? 10 million. The fair value adjustment you are given 10 million. And that is what you are going to literally consider. The fair value uplift on plant, or rather fair value adjustment, I'm having 10 million. So we are going to have our 10 million here. This will give us our net assets. What will be our total net assets at that point? My net assets, therefore, I should be having it as simple. So about 80,000 plus 18,200 plus 10,000. This should give me 108,200. Net assets, I'm having 108,200. Whereas our goodwill, I'm having 124,800 plus 24,000. This should give us 148,800. So we take the purchase consideration and fair value, we less our net assets. In this case, you're going to determine 108,200. This will literally give us our goodwill of 40,600. 40,600. This should be our goodwill. This will be our goodwill. As simple as that. That will be our goodwill. So I know very well that this goodwill is going to be taken in our SFP. So kindly know that. I know one will ask Mwalimu, what if you are having a negative goodwill? How are we supposed to take that? Remember, negative goodwill, that indicates that whatever that you are acquiring is more than what you are paying. So in that case, you'll find that we are having what? An earning. That is like a gain on our end. Because whatever that you are paying is actually less than what you are acquiring. So literally that is what you should be having in terms of gain. In this case, we had a positive, so that's a goodwill. I'm having it at that point. Okay? So once we have determined our goodwill, remember we are clearing our stages in terms of literally our entries, or rather our workings. The next bit that I want us to consider then is for us to determine our retained earnings, right? I want us to determine our retained earnings. Basically, note somewhere goodwill, note somewhere that we have our goodwill. We have our goodwill of what? We have our goodwill of 40,600. We're having a goodwill of 4,600. Kindly note it somewhere. We're having a goodwill of 4,600. Then, after that case, the next procedure, let us determine our retained earnings. Right? Let us determine our retained earnings. This will be very simple. So, allow me to erase this point. I'll only leave it for maybe the aspect of post-acquisition. So, allow me to erase this bit. Allow me to erase this point. So I need to do maybe 3 more workings, then we can just copy paste SFP, which will be very, very easy now. So I need to determine retained earnings to be reported here. Retained earnings, to be reported in SFP, to be reported in SFP, statement of financial position. And you determine or retain earnings to be reported in our statement of financial position. Do you have our format? I know we have our format, right? Because whatever that you need to do is, number one, to take the aspect of the reported profit that I was given. So I'll be having here my reported profit. We are going to adjust all this by what? Number one, we are going to adjust all this by talk about aspect of post-acquisition profit. Post-acquisition profit. We start with the aspect of in subsidiary, right? And of course, in aspect of associate, if I'm having any, and of course of what? In joint. And remember, we are talking of what? We are taking the parent share. We are taking the parent share. We are taking the parent share. So after all this item, we remember taking the parent share. We need also to come and determine if at all we had any form of what? Impairment loss. If I will be having any impairment loss. So that one you also need to consider that. So whatever that I'll be having here, this will give us the retained profit to be reported in our SFP. As simple as that. So we start with our work. What was the reported profit? Let me share this question with us so that you can have everything here. I'll just put it at this point to enable us to work it out. Check our reported profit in the books of the parent company. In the books of the parent company, I can see my reported profit I'm having aspect of, that is of course the retained earnings that I was given as at the beginning of the period. That is number one, as at the beginning of the period, you can clearly see that. Then number two, I can clearly see I was given what? I was given basically during the period. So literally, I'm having reported profit here. I'm having basically 20, that is of course 62,400. We add 62,400, we add 21,700. This is what was reported, right? This will give us a value of how much? This will give us a value of 62,400 plus 21,700. That will give me 84,100. So I'm having 84 here, 100. Okay? The next item is to consider the share of profit post-acquisition in the subsidiary. So what will be our post-acquisition profit in the subsidiary here, my good students? Post-acquisition profit in the subsidiary, what will we be having? Look at the books of subsidiary. During that year, how much did we make? How much did we make? During that year, we can clearly see which you had computed it earlier on. You see this case, we have it here under the net assets. We had made a value of 10,800. 10,800 was for the whole year. The 10,800 was for the whole year. Our period of post-acquisition is only 6 months. So therefore, we can agree and say here that my post-acquisition will be the 10,800 by half to give us 5,400, right? Then we adjust it with number one, if at all you are having any unrealized profit. Number two, if you are having any component of the aspect of depreciation, aspect of maybe depreciation undercharge. All this item we are going to adjust with our profit. So number one, you adjust it with unrealized profit. Number two, you're going to adjust that with your depreciation undercharge. Do we have any? Many a times this one you're going to get it in your additional information. So if we check our additional info, if we check our additional information, that should be, we start with note 1. We start with note 1. So note 1, what do we have in note 1? Note 1 there, my good students, I can see I'm having a fair value adjustment, which was a value of 10 million, right? So I'm going to have my 10 million there. In this case, it had a useful life of, basically, we were given 10 years. It had a useful life of 10 years, right? So having a useful life of 10 years, in this case, we come and take the value of what? How many, the post-acquisition period was what? 6 over 12, right? So I'll be having basically here 6 over 12. So that should give us the depreciation that we were supposed to charge, but we didn't charge, to be what? 10,000 divided by 10 times 6 over 12. This literally should give us a value of, I'm getting a value of 500. I'm getting a value of 500. So minus 500. Identify if we had any unrealized profit. Unrealized profit in this case, we had already gone through that question. Unrealized profit, kindly check note number 3. Was it note 3, note 2? Kindly check note 2. Kindly check note 2. Kindly check note 2. So note 2, clearly here we are given, let me remove this bit. Kindly check note 2. Kindly check note 2. Note 2, these are what we are told with our good examiner, that on 28th April, Shiba Limited sent goods at an invoice price of 7 million to Pika Limited, which Pika Limited neither received nor recorded until 5th May. Shiba Limited had marked up those goods by 25% on cost. Remember, we had already we did this earlier on. So I'm given the sales and I'm given the cost markup. So that is to say, we can't use them together. I must convert our markup to margin. I had already guided you guys on how to convert your markup to margin. To convert markup to margin, you just take your numerator, you add it to your denominator. Like in our case here, my markup was 25%. So that is to say, I'm having like 1 over 4. So therefore, my margin should be 1 over 5. I take my numerator, I add it to our denominator. 1 over 5 of what? 1 over 5 of these goods, which amounted to how much? These goods amounted to 7 million, right? The goods amounted to 7 million. So therefore 1 over 5 times 7 million here. This one will give us what? 1,400. So that is what you're having there. That is what you're having there. So in this case, we take the percentage of our parent, which is what? 75%. So times 75%. That should give us what value, my good students? See how these things will always be very, very easy. That's why I mentioned that there are some things that you can literally use your calculator for you to work it out. So I'm having basically 5,400 minus 500 minus 1,400 times the share of the parent, which was 75%. I'm getting 2625. 2625. What about post-acquisition in associate? Did you have any? Many a times you're going to get this in your additional information if you're not given your income statement, or rather the retained earnings in what? In our SFP. So I want you guys to check note number 5. Go straight to note 5. Amoa Limited reported a profit after tax of 4 million for that year. And in this case, profit after tax for the year was 4 million. Percentage of NCI, or rather percentage of the parent, we had what? 30%. That one was just direct. So that should give us 4,000 times 0.3 to give us a value of 1,200 there. So I'm having a value of 1,200, as simple as that. Impairment loss. Did you have any impairment loss? In our question, we had seen an impairment in terms of associate. Check note number 4. Check note 4. Note 4, we are told that impairment tests performed on 30th April reveal that goodwill on acquisition of Shiba Limited had not been impaired, but due to declining sales of Amua Limited, the value of investments in Amua Limited had been what? Had been impaired. By how much? By 2 million. 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 So I'm having 2 million. Associate, this one, was associate affected by our period? Check out if associate was affected by our period. When did you acquire the associate? Associate, we also acquired it on this period here. So the 4,000 was for the whole year. So I need to determine by 6/12. This should give us what? 600. And that's why it's always very good, because I've just looked at whatever that we prepared here and look at when were we acquiring the period, or rather the investee companies. So 4,000, whatever that was given in that note was for the whole year, right? So what about for this period of post-acquisition? Because literally everything here is post-acquisition. So once I have that, I can easily determine the value to be reported in our SFP. The value to be reported in our SFP, which will give us how much now? We pick our calculator. I have 84,100 plus 2625 plus 600 minus 2,000 minus 2,000 minus 2,000. I'm getting a figure of 85,325. Are you getting the same figures, guys? 85. I'm having 85 here, 325. So kindly mark this value. Mark that value, right? It will assist us. After that, the next bit will be what? A matter of copying and pasting. Now for NCI to be reported, this one now will be very easy. NCI to be reported in SAP, to be reported in SAP. This one should be very easy, because we take the fair value of NCI, right? Fair value of NCI. Fair value of NCI. Do we have the fair value? Yes, we had already computed our fair value. We had already computed our fair value, and check our fair value on top here, right? We had computed it to be 24,000. So I'll be having 24,000. The NCI percentage of post-acquisition. So post-acquisition profit. What will we be having? The same value here. Actually, this gave us what? 5,400 minus 500 minus 1,400. This value, I'm taking the exact value that we had on top here. So this should give us 3,500. We take the NCI percentage, which was 25%, because the 3.5 was literally our post-acquisition profit, right? So I'll be having 3.5 by 0.25 to give us a value of 875. So I'm having 875. Identify, my good students, if we had any aspect to do with impairment loss in our which affected our NCI. I don't see any, so that should give us a total format. Just a moment here. Just a moment here. So you'll find that at times these concepts are always very easy. If at all you are able, remember the concept that we said earlier on, because after this point, our task will just be a matter of what? Copying and pasting. After this point, our task will just be a matter of copying and pasting. Won't struggle much. So just a moment here. Okay, so basically in this case, you should be having a figure format if you determine the total. I'm having 24,000 plus 875. 24,000 plus 875, this should give us 24,875. The NCI to be reported in our SFP. The NCI to be reported in our SFP. What will be the next item here, my good students? The next item will be simple. It will be upon us now to determine, because I'm having an associate, let us determine the associate to be reported in our SFP. Then we'll be through with all these workings so that the remaining time, like not more than 10 minutes, we'll be through with our statement of financial position, right? Mark for me these figures. Retained earnings, the goodwill item, mark for me that one, please. We're going to use them. We're going to use them. So, investment in associate. Again, that would be very, very simple. Why? Investment in associate, that one will be very, very simple. Why? We take what? We only take this is investment to be reported, right? Investment. That is, of course, the investment in associate. Investment in associates to be reported. This will be very easy. Why? We take original investment, the investment that was made. We're given what? If at all, you can check on the initial component that I was given on top. Let me have this other page. See the investment that we made. The investment in associate that we made, I'm having what? 24, right? I'm having basically 24. So I'm having 24,000 here. So literally I'm going to have my 24,000. What else affected our associate? What else affected our associate? So I'm having investment of 24,000. What else affected our associate? Check. That was note number 5. I'm having a profit that we made. So in this case, I'm having the profit that we made. So share of post-acquisition profit. Share of post-acquisition profit, right? What will we be having here? What will we be having, of course, in associate? I'm having the 4,000, right? This was for the whole year, times 6 over 12, times our share, which was 30%. In that case, that will give us what? 2,600. This should give us 600, right? Can you confirm? 600. So once we have that, I think the next item to consider is the same case as what you're having here. Consider any impairment if we're having any impairment, right? Did you have any impairment loss in this investment? We had an impairment loss somewhere, which we had a figure for 2,000. That was our impairment loss. So that as at the end of the day, how much will we be having? You'll find that these figures basically are very simple. Where is my calculator? I'll be having 24,000 plus 600 minus 2,000. In this case, that should give us what? 22,600. 22,600. That is a value to be reported in the investment, right? Investment in associate. So, my good students, as Morimo had mentioned that those were the main workings. And once you have these workings, you are literally as good to go. So the next item that we need to do now is to copy and paste our statement of financial position. And that's what I want us to do now. It will take us more than 10 minutes once we have this. Kindly mark for me all these figures here. Okay, so basically on that case, what I need us to note is the computation that we have computed in terms of our working, so that it will make our work to be much easier. In this case, of course, you're going to start with number one. That is, of course, goodwill that we've computed. We just mark them somewhere. So basically, I'm having goodwill here that we've computed. And we've marked it there to be a value of 4,600, right? So I'm having a value of 4,600 on goodwill. Talk about associate. We have worked it out to be 22,600, right? Talk about the other aspect that we had. In this case, I'm just marking down the values that we had computed. That is, of course, the investment in associate. You can see it is 22,600. Other value, it is at the value of NCI. The value of NCI, basically, we had computed it to be, the value of NCI, we had computed it to be 24,875. So NCI, I'm having 24,875, right? We talk about the other item here, which will be, of course, what? We've looked at all the other concepts, I think. The main items that we should always be having at the back of our mind. So once we have this, I'm going to literally erase all this so that you can work it out. You'll find that once you're done with the statement, all these other things will always be very, very easy to do, my good students. All these other items will always be very, very easy to work them out, right? So on this case, we now prepare our statement of financial position, which will take us not more than 10 minutes. Picker Limited, Consolidated, right? Statement of financial position, as at 30th April 2023, right? So you'll find that this will be very, very simple, because our task now is just the amount of what? Copying and pasting. That's the beauty part, right? Should I display this one? Because we have marked our figures, and you guys, you have the figures, right? So let me have this question for us to basically copy paste. We start, of course, by our PPE, right? We start, of course, by our PPE. So our PPE, in this case, I'm having line by line basis. Remember what we said, line by line basis. So I'm having PPE. This is non-current assets. Allow us to basically consider our non-current assets. So I'm having non-current assets here, non-current assets. We start by whatever that I was given there, PPE, property, plant, and equipment. So PPE, we add on a line-by-line basis, that is 135,000, right? Plus 100, 400, my good students. You adjust with the fair value adjustment, which in this case you're given 10,000. You also adjust with the depreciation undercharge, which in this case you had computed it to be 500, right? Then we look at the item that we have computed there. I'm having our goodwill. Goodwill in this case, we had a figure of how much? 4,600, right? So I'm having 4,600. Investment in associate. Investment in associate. We have already computed that, and I believe you guys, you can see how we worked it out. That is, of course, 22,600, right? So the first bit that should give us what? I'm having 135,000. We add 100, 400 plus 10,000. We less 500 to give us, of course, 244,900. Determine that total. The total should give us 244,900 plus 4,600 plus 22,600. I'll be having a figure of 308,100, right? Consider our current assets. Current assets. Line by line basis. We check what was given there. I'm having basically our inventories. So we are having our inventories line by line basis, 28,400. We are going to add 12,100. You adjust with any component of goods in transit. My good students, if you can check our question, you are given goods in transit in note number 2, 7,000. In this case, we had 7,000. On the same note, we also computed our unrealized profit, which you need to adjust with it based on our format. And I know you have the format. So we're just following our format. Then consider the other item that I was given there, which was what? Aspect of trade receivables. So on our trade receivables, basically, line by line basis, I'm talking of 27,500. We add 19,900, right? We consider any intercompany sales, and in our case, if all of us can go to note number 2, right? We had the intercompany sales, the goods in transit, and before that we also had another intercompany sales of 6,000, right? Then in our case, we go to cash and cash equivalents, right? So for cash and cash equivalents, we add them on a line by line basis. In this case, I'm having the 10,600, right? We add the 6,800. So this will give us a total value of, we start with our inventories, 28,400. We add 12,100. We add our goods in transit to less that item of unrealized profit to give us 46,100. 27,500 plus 19,900 minus, that is a total of 13,000 to give us 34,400, right? Then 10,600, we add 6,800. This should give us 17,400. This total should give us total current assets of how much? Total current assets of 17,400, 34,400. We add 46,100 to give us 97,900. So my total assets here we should be having our total assets to be I should be having therefore 97,900 plus 308, 100, which would give us 406,000, right? Remember now we are just copy pasting what we did, right? Talk about equity and liabilities. Equity and liabilities. We know very well that on equity and liabilities, in term of equity, we'll be taking our ordinary shares, right? Talk about our share premium if we'll be having any. Talk about retained earnings. And talk about our NCI. And my good students, you must always be very, very keen. In the event that you are given the aspect of share exchange as part of our consideration, there could be two items which could be affected: the share premium and the ordinary shares. Okay? So, looking at that case, look at the reported ordinary shares. The reported ordinary shares you are given for the parent, that is our consideration, we're given a figure of 160,000, right? But they were shares that basically we were acquiring. And the shares that we were acquiring literally here, we were having plus. How many shares are we acquiring? We are acquiring 3/5 of the 8,000 shares of the percentage that I was having here, 75%. So literally, this will give us a total value of shares that we're acquiring to be 3/5 times 8,000 times 0.75 to give us 3,600 shares, right? Times my par value. Per value, we had 10. So that is to say, I should be having by 10, this should give us what? 36,000. And already we had computed that. So I'm having 36,000 here plus 160. This should literally give us what? 196,000. Remember when we started, this is what we started with. We started with that one, right? Share premium. Market value. Look at the market value on our first bit there. The market value of these shares that we are acquiring basically were 13. So let me do this here so that all of us can understand. So look at this case. My market value, right? Our market value in this case, we were given 13. Per value of the shares, we had 10. So this is to say I was having a premium of how much? 3. So in this case, therefore, we can say the 3,600, the shares that we were acquiring, we had a premium of 3 because the par value was 10 and this case the market value was 3. So what will be our premium? 3,600 by 3 to give us 10,800, right? Retained earnings. We had already computed this retained earnings somewhere, right? Remember when we started our main workings, we had computed our retained earnings, and if you can recall, we had computed retained earnings and NCI at once. So in that case, if at all, you can check basically our retained earnings. We check our retained earnings and of course our NCI. I didn't note it, but you guys, I know you noted that one. Our NCI, we had a figure of 24,875, and retained earnings we had 85,325 as per what you had computed, right? As per what you had computed. Check it out. Our retained earnings, we see we had a figure of 85,325, whereas our NCI, we had 24,875. So that as at the end of the day, what will we be having here as our equity? What will we be having there as our equity? So my equity, I should be talking of 196,000, right? We add 10,800, we add 85,325, we add 24,875. 24,875. And that is why it was very important for us to have computed what? To have started with our workings, because you can see our work is now just copy pasting. So having our equity to be 317,000, we proceed to our long-term liabilities, and long-term liabilities as per what the examiner has given us here. Number one, we're having non-current liabilities, right? Non-current liabilities, which we will be talking as follows. Basically, it's just a matter of combining them on a line-by-line basis. As per our question here, look at our non-current liabilities. I'm having what? 10%. So basically, I'm having our 10% bank loan, 10% bank loan, add on a line-by-line basis 25,000 plus 10,000, right? I'm having the deferred tax here, deferred tax, add them on a line-by-line basis. We should be talking of that is 3,700. We add 3,100, right? So that should give us what? This should give us 35,000. This other one should give us 3,700 plus 3,100 to give us 6,800. In total, plus 35,000, this should give us 41,800, right? Then talk about our current liabilities here. Current liabilities, we should be having, take the figure that I was given there. I'm having, of course, our trade payables. So for trade payables, we add them on a line-by-line basis. 28,800. We add 21,200. Remember, in terms of goods in transit, we debit our inventory, we credit our payables. So crediting our payables with the goods in transit, which was 7,000. Then we less any intercompany sales. In this case, we had intercompany sales, which will be the same as the trade receivables, which we are having 13,000. That was as per note number 2. That is 7,000 plus 6,000, right? Then I'm having the current tax payable. So current tax payable, line by line basis, 1,900. We add 1,300. This should give us what? We just take it the way it is. I'm having, of course, our item here, which should be 28,800 plus 21,200 plus 7,000 minus 13,000. This should give us 44,000. Kindly confirm if you're getting the same values. Then The other item I'm having 1900 plus 1300, which should give us 3200. We add plus 44,000 to give us 47,200. That is what Mwalimu is getting. 47,200. So what will be our total equity and liabilities? Can you clear that? Or you're going to say, Mwalimu, fanya kazi yako, right? I know we can clear that. Or are you going to say, Mwalimu, fanya kazi yako? So let Mwalimu do his work, right? So just a moment here. We are having basically this to be quite easy because it's just a matter of adding. Just a matter of adding. Just a matter of adding. So adding the three items. Adding the three items. Adding the three items. I can literally remove this bit here. Adding the three items, which will be 317,000. We add 41,800. We add 47,200. That should give us 46,000, right? That should give us 406,000. So that is how we are supposed to work it out. That's how we are supposed to work it out. You can clearly see, my good students, that once you're good with the entries and once you've mastered what Mwalimu told us to start with, consolidation is always very easy. Consolidation is always very easy. So these are what you're supposed to do, and you earn all your 20 marks, right? Whereby the question wanted us to compute our goodwill, investment in associate, and finally, consolidated statement of financial position. So these are what you are supposed to do up to that point. In our next segment, of course, you're going to look at a question with income statement. This was SAP. And remember, so we started, we mentioned that my friend CPA Douglas is having an initiative, and this initiative is literally to give back, right? Giving back to the accounting industry, and that is basically, of course, CPA students. And there's an aspect of we are donating the books. So if you have a book somewhere which you're not using it and it is for any CASNED course, kindly you can reach out to the number that I gave for CPA Douglas. Or if at all you want to support in another way, that is the details that are presented there. Just below this, you can always click that point. And of course, in this case, you're going to support this initiative. To that point, guys, thank you so much. We meet in our next class. We revise a question for income statement consolidation. Thank you so much. See you in our next class. Bye-bye.